In 2025, thousands of ETFs failed, but three didn't just survive. They quietly became too important to shut down. They hold over $500 billion, charge almost nothing, and now sit at the center of global investing. Most people think fund survival is about performance. That belief is wrong. And today, I'll show you why these three ETFs are becoming impossible to kill. If you're investing for the long term, here's a question almost no one asks. Will this fund still exist when I need it? Because returns don't matter if the product disappears, freezes, or becomes illiquid during a crisis. Survival in markets isn't about hype, it's about structure. And structure is what separates permanent funds from temporary ones. In 2025, three Vanguard ETFs crossed a critical threshold. One covers the entire U.S. stock market, one captures global stocks outside the U.S., and one represents the entire U.S. investment-grade bond market. Their names aren't exciting, but that's the point. They've become the plumbing of modern portfolios. Let's clear up a myth. ETFs don't die because they underperform for a year. They die because they're too small. No one trades them. Market makers walk away. Fees can't cover costs. When that happens, the fund closes. And investors are forced out at the worst possible time. Now here's the difference. These three ETFs don't have millions. They have tens and hundreds of billions. At that scale, closure becomes almost unthinkable. When an ETF gets big enough, something changes. It stops acting like a product and starts acting like infrastructure. Big funds create their own liquidity. Spreads tighten. Institutions step in. Retirement plans adopt them. And once institutions rely on a fund, removing it becomes a logistical nightmare. That's how scale turns into survivability. Now let's talk about fees. These ETFs charge 3 to 5 basis points. That's not just cheap, that's structural dominance. Over 20 years, the difference between 0.03% and 0.5% can mean hundreds of thousands of dollars. Low fees pull in assets. Assets create scale. Scale lowers costs even more. That loop is almost impossible to break. Survivability only matters in a crisis. So let's look at real ones. The dot-com crash, the 2008 financial crisis, the 2022 bond collapse. In every case, these broad market funds stayed open, stayed liquid, kept trading. Even in 2022, one of the worst bond markets in history, the total bond ETF didn't fail. It functioned. And that's the difference between pain and catastrophe. Most investors think safety means not losing money. That's wrong. Safety means you can trade when others panic, you can rebalance when prices break. You're not forced into bad timing. Liquidity is insurance, and massive ETFs provide it when it matters most. Looking ahead, 2026 won't be calm. We're likely to see gradual rate cuts, uneven global growth, AI-driven capital spending, geopolitical shocks. No single asset wins in every scenario. That's why structure matters more than prediction. Here's the truth most investors miss. Funds don't survive because they're loved. They survive because advisors trust them, plan sponsors depend on them, custodians build systems around them, regulators prefer their simplicity. Once a fund reaches that level, it's no longer optional, it's essential. The most durable investments aren't flashy. They're broad, cheap, liquid, boring. A total U.S. stock ETF, a total international ETF, a total bond ETF. These aren't predictions. They're foundations. And foundations survive storms. Most people chase what's new, but systems rely on what lasts. If you want to invest like institutions, not speculators, focus on structure, not stories. If this helped you think differently about investing, hit like, subscribe, and I'll see you in the next one.